We welcome you to Diwali festivities. We kick off our Diwali editions with perhaps the best from the investing industry, the broking industry. We have with us the cream of the creme de la creme from the mutual fund industry. Sunil Singhania, CIO Equity Reliance Mutual Fund, and Sailesh Raj Bhan, the Deputy CIO Equity Investments at Reliance Mutual Fund. Both of them join us to kick off our Diwali celebrations and discussions and analysis. Sunil, Sailesh, thank you very much for joining us. We do appreciate you joining us today, and we wish you a very, very happy Diwali and a great Samvat ahead. But to kick off, Sunil, the global environment has given us some cause for jitters. What is the in-house analysis of the global environment itself? Do you think we're going to see some more deep cuts, considering that even yesterday, after good data, the US merely, lost 0.1%. That seemed to be the best it could do.
Right. At the outset, wishes to CNBC and its viewers on the festive season. I think you're right. The last 8-10 days for the global markets have been a very volatile period. However, actually, what is happening is basically, there was a lot of consensus trades which were being built up. So people were short bonds, long equities, and it felt that everything was moving in one direction. So I think it's a slight reversal of that trend. It's too early to say that this is the start of a prolonged sort of a volatile period. Our view is that it's too early. There will be some adjustments, but it will settle down. On the flip side, I think all this is actually turning out to be positive for India, because India is exactly on the reverse. So in the last 3-4 years, the world was seeing low inflation, low interest rates. India was seeing high inflation, high interest rates. I think for the first time, world is seeing higher inflation and higher interest rate scenario, and India, on the other hand, is looking at low inflation and low interest rate scenario. So in the near term, we'll definitely get impacted by what is happening in the world, but I think India will definitely stand out in this.
Okay. Sunil, Sailesh, hi, good morning, and happy Diwali to you and your entire teams. We have seen some disappointment on the government's end. I mean, people are not too happy with the fact that large-scale legislative reforms have not come through just yet. Do you expect the government to go through with some legislative reforms in the next 3 to 6 months, and what would top your agenda now?
See, again, if you see, it's been like a 5-month-old government. Yeah. In just 5 months, it's a new government. So I think after a long time, BJP has come to power. We have a new prime minister. Obviously, the first 2-3 months goes in settling the team. The prime minister has also been busy with a lot of his visits, which are also very necessary. I think what we are seeing now, we have had a reshuffle at the bureaucratic level. Our expectation is that things will pan out. But obviously, we being who we are, and, as Indians, we like to see things getting done on a daily basis. And there is definitely a section of the markets, of the economy, of the industrialists who are getting a little bit restless. And our view would be that we should give at least a few more months, before we start to get really, really restless. Things will happen. That is what our firm belief is. And, frankly, it's a matter of time. So between now to budget is a period where we need to definitely keep a track on. And if nothing happens in that period, then we definitely can get disappointment. But right now, I think it's still very early days.
Yeah, actually, quite a few FII investors we spoke to also said that they would give the government a rope, not a long rope, but some time till the budget. But the budget better contain some ideas to reset the economy. Let me get Sailesh Bhan also into the conversation. Just to tell you about Sailesh, he manages one of the largest equity funds. I think it's a 9,000 crore fund, Reliance Equity Opportunities Fund. That's not the only fund he manages. It's the largest flexi cap scheme in India, among other funds that he manages. Sailesh, what have you made of how to approach the growth story itself? As Sunil has been saying, there is a hope that, growth returns. At the moment, one part of the equation is probably setting right, inflation. But the growth part is not indicating any improvement at all. Would you go with growth stocks at all, considering the kind of funds that you manage? Will you stick to the TCSs of the world?
Sure. If you look at the year 2007, which was a very big year in terms of earnings growth for India, the top 30 companies in India grew in excess of 25-30%. Then you had a period where last 6 years where growth was on an average for earnings growth of the top 30 companies was just 6 to 7%.
Yes.
On a, and so if you accumulate 4-5 years, you end up with 1 year of 2007 growth getting reflected in this period. We are coming off of a very, very low base. And virtually every macro variable which was against us in the last 5-6 years is turning around. I've never seen so many macro factors working favorably towards us in this kind of a short period. Yes. And minute you have this kind of a environment, if growth doesn't return now, then there is some other serious challenges in this country. So I think there's a great possibility growth returns, and growth, because there are many industries which are young. There's so much of underpenetration of opportunities here, and I think you can have years of growth returning to India.
Okay. I know you guys...
So it is going to be a growth bias when you pick your stocks?
Certainly. Over a 3-year period, it will be a growth bias market when we look at it.
And when you say growth bias, what would it be? Would it be, auto stocks, which seem to be now, come rain or sun, seem to be considered a growth stock? Or will you go right down to the PSU banks?
If you split this, instead of seeing it sectorally, one should look at it more from a point of view of, who have invested in capacities in the last 3, 4, 5 years. Okay. We have seen a lot of companies who have invested a lot in capacities. And minute you have revenue shift happening for some of these companies, their profit growth, their operating leverage, everything will flow into their earnings growth, which will be superior to index growth. So that's where the focus is. And it could be across industries. The good part is this time it will be across industries.
It's more bottom up, you mean?
No, it's across industries. It's broad. It's very broad based. It is spread out. Unlike, look at last year, it was just a very narrow market, just a market which was just a 2-sector market last year. Okay. So this time you can have 7-8 sectors out of the 10 sectors participating.
Okay. I know you guys get asked this question a lot, but I'm still going to ask you. Last Diwali, the Nifty was at somewhere around 6,200. So it's a 25% growth that we've seen between last Diwali and now. What's the prognosis going forward? Do you think the markets will be higher next Diwali compared to this one?
I think, as I said, things are basically getting in place for India. On the macroeconomic side, almost all the indicators are turning positive. There is definitely this volatility in the world market, but if you see last 3-4 years, some part of the world has always been volatile, and we always get impacted irrespective of which part it is. And we also start with a lot of optimism on government actions, on policy decisions, and on the revival of the general economy. So I think all said and done, our view is that earnings growth can start to surprise with a lag of 1 or 2 quarters. And from our perspective, we are banking on an earnings growth of upwards of 20% for the next 5-6 years. So I think that is the basic hypothesis on what we are playing. So I don't know what the index would be in the next 1 year, but I think in the next 5 years, we're definitely looking at great returns to be made from equity markets.
But still, you would have some idea of what can be gained in the first year. I mean, it's not a very near-term target. It is still a 12-month target. Does it look like 9,000 would be easy picking?
Again, we are here to create wealth or try to create wealth rather than forecast indices. But Lata, if you actually see, yes, we have seen this 25% move in the markets, but still the PE of the index is a reasonable 15.5 times. If you just take FY15 as the base year, so we are not significantly expensive. And the moment the market starts to believe that earnings can grow upwards of 15-20%, then the PE also tends to go up. And in case we have a scenario which looks very likely that interest rates might start to fall, then not only will the earnings rise, but also the PE multiple correspondingly will also rise. So I think it's a combination of a lot of factors. With some luck, we can get. And I think luck is already sort of, having its blessings on India. You have crude, which has fallen to like $85, and it was really, really unexpected the way it fell. And with a little bit of more luck here and there, we might see that level.
Since you're repeating the interest rate and the inflation argument so many times over, what's the breakup between, say, a fixed income investment and equity investment, at least for the next 1 year? If there is so much of a guarantee that inflation is reaching 6% in a year, is there some very easy money to be made in the fixed income side?
We were just discussing yesterday in office that Greece GSEC yields have crossed India's GSEC yields. And it was very surprising that Greece GSEC yields were so lower compared to India. India has never defaulted in its history. And still we are having a GSEC yield of now 8.35, 8.37%. So there is definitely merit in the argument that the 10-year government GSEC yields will also come off. But I think if you actually see, even without RBI cutting, on the grassroots level, interest rates have started to come off. Banks have started to reduce their FD rates. The base rates, even yesterday one prominent bank reduced its base rate. So that's already started to happen. Now the allocation between fixed income and equity is so skewed against equity that, it's like 2% in equities. So I think there's a lot of room for investors to invest in equity. And what the last year has done has shown that, 1 year can make for the disappointment of the last 3, 4, 5 years. So now on even a 5-year basis, funds are returning like 18, 20% post-tax. And I think that is what investors are noticing. And our view is that this reaction, you would see the flows into mutual funds, in fact, increase manifold.
I was just going through some of the stocks that you guys have sold in the month of September from your existing portfolio, and I noticed you have a lot of oil marketing companies in that list, names like BPCL, IOC, etc. Sailesh, do you believe that the best is over for the oil marketing companies, and even if there is any policy reform, it's already been priced in?
These companies have come off, these businesses, in fact, are now seeing possibly their best times in terms of, the subsidies coming down, the under-recoveries reducing substantially. A reasonable amount of reforms are required here to see and capture the next level of growth here in these kind of companies. And also, we have always seen when this kind of phase happens, the private refining companies do come up and gain market shares. So we need to evaluate this continuously. So there's no one directional call there, but I think we'll need to evaluate it very carefully.
Okay.
You said about wholesale rates falling even before the Reserve Bank cuts. Actually, I think the latest debenture floated by one NBFC is at 11.75, and if we remember, all those gold companies were floating at 13% a year or two back. But you have sold those companies. Manappuram, I think, is one of the stocks you have sold. As well, you have sold MMFSL. NBFCs should not be a picking for you, or is there some valuation argument over here?
See, as a fund house and as asset managers, rebalancing of the portfolio is a daily affair.
So it gave you gains and therefore you sold?
So it's a mix of a lot of things, Obviously, there would be something which would be more sort of, you can say, attractive at that point of time. So I think with the corpus which we have to on a continuous basis maneuver, and that does not mean that we've become over bullish or bearish on that particular stock. It's more a relative call which we keep on taking.
Basically, you think NBFCs are also important picks?
They are important picks, but some NBFCs had basically the valuation had gone beyond what we felt was a fair value, and on the other hand there were stocks, Sailesh mentioned, there were some growth stocks which were not growing but which had the potential of growing, and therefore it's an asset allocation sort of a bet. It's not that we have been very negative on the stocks you mentioned or otherwise.
No, there could be, because for instance the other sell that you have is the other stock you have sold is Bharat Forge, which gave just phenomenal gains. And is it a question of just screening some gains, or do you think the Mothersons and the Bharat Forges have run their course? And now with the rupee somewhat appreciating, actually, along with the dollar against most trading partners, the best is over for these auto anchs?
I think auto ancillary as a segment has a lot of potential. In India, the auto segment has been growing or started to grow quite rapidly, and even the commercial vehicle segment is showing signs of growth, and some of these auto ancillary companies will benefit from that. Even internationally, I think auto ancillary companies in India have started to make a mark as far as exports market are concerned. Having said that, again, there are some stocks where we have large investments, and as risk measurement and rebalancing, it's always a case of trimming or buying something else. So I think you should not read too much into what we do on a daily or a monthly basis.
I wanted your views, Sailesh, on the metal sector. I was noticing that a couple of stocks that you've added to your portfolio include the likes of Nalco, Tata Steel, etc. But we are seeing some petering of demand globally, especially from China, etc. What's the view now, for the next 6 to 12 months, on how to approach the metals, both ferrous and non-ferrous?
Metals are seeing, certainly, because of the global slowdown and the China challenges which are there, they're definitely seeing a significant downturn. In fact, all prices have corrected meaningfully. In fact, possibly this is the weakest year in a long time for commodity stocks and commodity prices. Our case is, in very good quality businesses where, a threshold, like in certain segments of the market and all that, you're finding good value, right? So we are participating in those places with a 3-year kind of a view. And also stocks have started to reflect this pain meaningfully. If you look at it, all these stocks are at some significant discounts to what they were even in the last 5-7 years. So we are still significantly underweight in the sector, and we are continuously evaluating, given that a lot of these businesses are coming to value zone. So if the prognosis that global growth doesn't go into significant challenge in the next 3-4 years, I think these businesses will recover.
So if value buying is, it's something that you're looking at, how would you approach the big falls that we've seen in TCS and HCL Tech post their numbers? I mean, 6 to 8 months down the line, one could have probably thought that, it was the best time to buy these stocks when they fell post earnings. Is that your viewpoint as well, that this is a good time to be going and grabbing some of these good quality IT names?
The top-tier IT businesses in India are actually very well positioned globally, in terms of the kind of market share gains they are having. And in fact, the technology shifts which are happening in international markets, whether it is, the mobility space or whether it is the cloud space and things like that, our companies are this time at the start of the wave. Unlike in earlier phases, they were not in the start of the wave. They came in later after the ERP was built and stuff like that. So I think these companies are well positioned to deliver reasonable growth over a period of time. These businesses are well positioned to deliver reasonable growth. And we are continuously evaluating as a part of our portfolio on how we are positioned in it. So today in certain pockets we are underweight. We will possibly look towards that particular sector very closely now.
Okay, we are just trying to get some help from you in how investors should approach various sectors. And in fact, you all have even some sector funds. But that apart, I'm asking you basically if you got money into your flexi cap fund or into your pure equity fund, say 100 rupees, how would the split be sectorally?
Like I mentioned, this time we are seeing growth across many sectors in the market, right? It's unlike last year where you just have 2 or 3 sectors delivering. The good part is after a phase of correction, even in those sectors which have done well earlier, the consumer and all that, valuations there are becoming now rational. They are not very cheap, but they're still rational. When we are seeing a broad-based GDP and economic growth recovery in India, you will find value emerging across sectors. So maybe today, given the global growth scenario, the global sectors might be a little bit muted to buy, but I think domestic growth recovery as it accelerates and we get along with the next 2 or 3 quarters will present a lot of opportunity. We are overweight on engineering, product engineering businesses in India. I think that is a sector which continues to be good. And we think the growth recovery in these spaces, that particular space will surprise. Pharma continues to be steady. We are comfortable with allocating both in domestic and international pharma companies. And the other banking continues to, at least the public sector bank space, the top tier banks are continuing to come back in terms of better operating performances and lower costs. And as asset quality improves over a period of time, I think that space will also benefit. Private sector banks, I think the top tier banks are doing well, gaining retail market share, having strong CASA and stuff like that. And as a broad-based recovery happens, these will be one of the meaningful beneficiaries of that. So these 4-5 sectors, including auto, would be there. If you look at theme-wise, I would want you to evaluate theme-wise, urban discretionary recovery, I think would be the first starting point for this, because that was where the sentiment had hit the worst last year. And I think when you have a recovery there, whether it's auto, whether it is organized retail, whether it is, these kind of areas, you'll find a recovery which is faster.
Actually, that's interesting because even Ambit was talking about the same theme a couple of weeks ago. Home improvement, urban recovery, etc. But, Sunil, I just wanted your viewpoint because I think you have your ear to the ground more than anyone else we know. In terms of what the retail investor sentiment is now, have you seen retail demand pick up a lot compared to what it was, say, 6 to 8 months ago?
No, definitely. I think, earlier when you used to go for investor forums, the number of people who used to attend then, and this is 6 months back and now, it's completely big change. Okay. And as I said earlier, this last 1 year return has shown the investor that even the last, before that 2-3 years of challenges also made up I1 returns. So the index has gone up by 25-30%, but funds have gone up by like 50 to 70% in the last 1 year. And I think that is what investors are looking at. Having said that, I think investors are now much more rational also. So the days of investors expecting 100% return in 6 months are now behind. Investors are looking at steady, good 15-18% return. And more so because the alternative investment avenues like real estate, gold are not doing too much. And in fixed income also, after the recent changes in taxation, on a post-tax basis is not as attractive as maybe equity is. So I think across a feel-good factor, equity markets doing well, on a post-tax basis, equity becoming much more efficient, and big under-investment in equities. I think all this is leading to investors, moving towards equity. In fact, one of the funds which we did just 15 days back, we had almost 50,000 investors invest in it. So I think it clearly shows that now investors, even on not only HNIs, but to some extent even the retail, is looking at equities.
Okay. Sunil, give us some idea of how much your funds or the industry has got, say, in the last one quarter. And has this come largely to equities? Can you give us the equity fixed income split?
I can talk about equities and then I can give you the overall picture. So on equities, on an average, the industry has been getting $1 billion every month for the last 3 months. And we have approximately 12 to 14% market share. So that would be our inflows. And overall, as an industry, there was an expectation that after the budget announcements for fixed income, there would be massive drawdown on fixed income. In fact, that has not happened. That clearly shows that, in fact, assets have gone up. So that clearly shows that taxation was only one aspect of the debt mutual fund. It was convenience, it was security, it was professional management, which was bringing in investors. So I think even on the fixed income side, you have seen growth. And equities, as I mentioned, has been, after like 4 years, we have seen equity funds getting fresh inflows.
Well, we have seen a continuous selling by FIIs entirely the month of October. About $500 million have been pulled out. But DIIs have come in. Do you think this trend is likely to remain now, that there is sufficient faith among the domestic investors in the Indian market that we shouldn't worry about temporary pullout of FIIs?
Domestic investors started to come in seriously and meaningfully. The allocations still are very, very low, but I think on month we are finding the interest going up substantially. So it is a good counterbalance to the only unidirectional flow which used to be there in the last 3-4 years, which was FII driven. So I think it's a good case that there's an opportunity for Indian investors to participate, and they're seeing this as an opportunity. And we think this balances out a lot of volatility and
Okay. So you want to leave us with one Diwali gift for our viewers, a top stock idea, top sector idea? I'm just trying my luck.
I think Sailesh already mentioned about the urban discretionary theme. I think that's a very, very strong theme. We believe that there are other small themes. Lata mentioned about home discretionary. I think that we've been playing for the last 1 year. But beyond that, I think homegrown brands, which is still a small theme, can develop into a larger theme, because now the avenues of sort of selling have improved or increased manifold.
So what are the stocks we're looking at there?
You can see some of them in our portfolio.
No, avenues of selling. Actually, I wanted just to complete with that theme. Just up until 3-4 days back, or maybe a week back, we were so much all engrossed in the digital theme when Alibaba listed. Is that a big sector that you would look out for? Not digital or online sellers. There aren't so many of them perhaps, but all those transportation stocks, logistics stocks. Is this a very big story?
The sector is going to be large over the next few years, but the winners are not clear. So today people are investing in what is available. So are these the right businesses to own where ROEs will come over the next 5-6 years? It's a little bit early in the space. But the space will be large, and clearly India is a tipping point in terms of that particular sector. Likewise, there are many emerging sectors in India, whether it is your sector of media and entertainment or organized retail itself. All of these are very, very small in India today, and you'll have growth along comparable levels and meaningful levels in each of these areas in the next few years.
You're giving us personally a Diwali gift by saying media would do well. No, but leave us with some numbers. I mean, you spoke about, say, a 3-year rally in equities. What is the kind of percentage or number you are looking at for the Nifty or the Sensex?
I'll give you
and in that period, say in the next 1 year, will mid-caps be outperformed?
I'll give you a roundabout answer. If you just go back 2002 to 2008, Sensex earnings tripled. They went up from like 250 to 800, and the index went up by 6 times. Okay. Between 2008 to 14, ex-IT and pharma, Sensex earnings did not go anywhere, and the markets did nothing. Our view is that between 2014 to 2020, the earnings will triple. So, you can basically take a call.
That would mean 6 times. That's what
I don't know. I'm just giving you history, and I'm giving you our expectation of earnings. See, earnings expectation, we can try. Obviously, no one goes right. Even earnings expectation, you see the carnage in TCS and it's today. But, at least you have a view that this is possible. So from 1340 or 1350, which earnings were at FY14, we can look at a sort of a bull case scenario of 4,000 for the Sensex earnings by 2020.
And what
So I
about
think
the mid-cap index?
No, that's
Any
Sailesh's.
prognosis?
Sailesh, since you are the flexi cap guy, you tell us, in the next 1 year, will the gains in mid cap be double that of gains in Nifty, for instance?
I wish I knew. I think the good part is, you've seen a mid-cap rally happening. You've seen one good phase already happening in the last 6-12 months. Like at the start, as I talked about, overall market itself across the board is reasonable. It's not exorbitantly priced or exorbitant value. Even large caps are reasonably priced to that extent. So we may have, a possibility of benefit in both the spaces. Now, in a 12-month period, the mid-cap space will do disproportionately. It's a function of how much of growth returns. If growth returns very fast, normally you will find companies with lower bases growing faster. So that's the case. If you have an expectation that growth recovery is very, very fast and very early in the system, your call might be good.
We want numbers, not words, but well, you'll have given us some arguments to lead us to believe that perhaps we are in the start of many happy Diwalis. But for the moment, both of you, thank you very much for joining us, and have a great Samvats 2071 ahead.
Thank you for having us. Wish you a happy Diwali.